people are starting to get into investing, there are so many options out there, options for people with high risk tolerance, low risk tolerance, and it can be hard to come up with what do you want to invest in. So here to talk to me about this issue is Haley Tolitsky from Cook Capital. How are you doing today, Haley?
I'm doing well. Thank you for having me, Michael.
And I guess just getting started, for Retirement Daily, I ended up having the opportunity to invest $250 into anything I so choose. And a lot of what I went through when I was trying to come up with what I want to invest in is like a lot of what I went through was considering risk. I ended up choosing something low risk, but I want to ask you first is how should younger people assess risk factors when getting into investing?
That is a really great question, especially for the younger generation, because we probably haven't really considered what our risk tolerance is before. I think the easiest way to determine risk for yourself personally is to set financial goals and then tie your investment or saving strategies towards those goals. So if you have a shorter time horizon, for example, if you're saving for, purchasing a home or a car in the next year or two, you probably do not want to take as much risk as something that is a much longer time horizon, such as retirement. Now, that will still differ for everyone. Some people are more comfortable with risk, some are not. And when you think of risk, I often just think of seeing your investment fluctuate. So if you invest in the stock market, your portfolio can go up, it can go down. And so what we like to tell clients is with this strategy, can you sleep at night? If your investment strategy is keeping you up at night, you are taking too much risk.
And then what are some good options for people who have, say, low risk tolerance, medium risk tolerance, and high risk tolerance?
Great question. So right now we're in a really interesting time period. With interest rates being so high, you can actually earn a decent amount on your money without taking a lot of risk. And so there's a lot of different ways that you can go about this, but for low risk, you can look at different high yield savings accounts. So several online banks are paying almost over 4%, 4 to 5% on your high yield savings. And that's really liquid, meaning that if you need that money that day to pay something, you absolutely can do so. Taking a little bit more, not necessarily risk, but locking in your money would be like a CD. So those have a set rate. So also paying around 4 or 5%, but you do lock in your money for a certain period of time, whether that's 3 months, 6 months, it can go up to 5 years plus. So you want to think about that. And quite often you can take your money out of the CD, but you will lose the interest on it. So think about locking up your money for that time period. If we're talking about medium risk, then you may be thinking more so fixed income investments. So thinking about bonds. And then higher risk is going to be anything really in the stock market. And so obviously there are some investments that are riskier than others. You can diversify, which takes away some of that risk. But the stock market is really probably what you want to look at when you're thinking of longer term goals that you have.
Mm-hmm. And then I guess just looking at what I did. So I ended up choosing something that was very low risk. I ended up choosing to invest my money into a 12-month CD. And I just want to know, what's your opinion on that kind of investment? Is playing it safe the right option at times, or do you think I should have gone bigger at this age?
Yeah, so I'll turn that question back to you. What are you using this money for, or what are your goals with that investment that you made?
Personally, my goal going into this was to keep the principal secure. I wasn't really looking to lose a lot of this money because I just wanted to see what my options were out there, and I didn't want to throw it all away immediately.
Makes sense. Then that sounds like you picked the right strategy for yourself. With the CD, like I said, you earn interest on your principal, but there's very, very low risk of actually losing that. So it seems like you made the right decision for you based on your risk tolerance. Obviously, if you wanted to take more risk, you could consider investing in the stock market. But yeah, if you are not comfortable with potentially losing the principal that you put into your investment, then you definitely want to stay more conservative and looking at different bank type investment options.
Would you say, is there any harm in playing it safe?
Yes, so there is. If you look at the history, the stock market has done on average 8 to 10% as an annualized rate of return when you look back 50 plus years. So again, we're in a weird time period right now where interest rates are a little bit higher. So you're earning 5% on that CD, but historically the stock market has done much better than that. So I really think it comes down to looking at your money in buckets. So again, those short-term goals that you have, you don't want to take on as much risk, but then you have to be okay with giving up some of that return. When you're looking at longer term investment strategies, retirement or 5-10 years down the road, you can afford to take more risk because if your portfolio value goes down, you have time to make it up when the market rebounds. For shorter term goals, you don't have that. So yes, when you pick less risky investments, you are giving up the potential of a higher return, but you can't time the market, and so it really just depends on your timing of your goals.
Thinking now, just an overall question for anybody out there looking to start investing is there a certain amount of money you believe is a good amount to say, okay, now it's time to start?
Start anywhere. You can start with as little as like $20. So the worst thing that I see, especially with the younger generation, is we wait until I have $500, so I have $1,000, or until I buy a home. And when you're doing that, you're giving up time in the market where your portfolio could be growing. So start with as little as you can. I think the best way to start is by automating your investments. So just setting up a monthly bank draft of whatever you're comfortable with, $50 a month. And then as your income grows and you get more comfortable, you can obviously increase that. But the key really is just to get started and to get comfortable with it.
What other advice do you have out there for young people looking to start investing? Do you think that there's one perfect place to start? Or like I did, should they assess their own situation?
Yeah, it's going to be completely dependent on your specific situation. Obviously, if you have shorter term goals that you're saving for, you probably want to be a little bit more conservative. For younger people that are looking to invest, for retirement in the long term, a Roth IRA could be a great option for you. So you may want to look into that further. And there's also brokerage accounts that may be better for midterm goals. So honestly, there's no one size fits all when it comes to investing. So it really depends on what your goals are, how much money you have, what your income and your cash flow looks like. And then from there, you can make the decision that's best for you.
And what are some good places in the news what are some good news stories to watch out for when you're trying to make these decisions? Like how should people be informed?
Great question. And so what's great about having the internet these days is there's so many resources, right? But I always like to tell people to fact check. So just because you read something online or you see someone on Instagram or TikTok sharing about a specific strategy, double check your resources, make sure that person is credible to be giving that information. So finance reporters are a pretty credible source online at any major news outlets. If you're hearing from specific advisors themselves, you want to make sure they have the right credentials. For example, the CFP, Certified Financial Planner. Not every great investment advisor is a CFP, but that is one way that you can kind of look for credibility. There's I see these personal finance coaches out there, and some are giving some really great advice, but others not so much. So it's great to do your research, but always make sure that you're double checking your facts and your sources.
What's your opinion on people looking to AI resources for some of this advice?
Yeah, it's been really interesting to see the shift with AI. I think it can give some good advice. I've seen some studies here and there, but again, I think it's really important to understand that is general investment advice or whatever type of advice it's giving. It's not specific to your situation. So it can be helpful to help you make an educated decision, but just remember it's not one size fits all.
And is there anything else that you'd like to talk about that I didn't bring up?
I don't think so. These are really great questions. Again, I think it's just getting started. You'll get more comfortable with it as you age and get more experienced, but really getting started today is the best thing that you can do for your future self.
All right. Thank you so much for talking to me today, Haley. I hope you have a great rest of your week.
You're very welcome. Thank you.